So the one that I want to hit on, because this one came in a couple times this week in various forms. I'm going to read you one. I'm going to leave the person nameless. I'm going to read you one here that came in 2 days ago. So it said, I'm not interested in a qualified opportunity zone fund because as I've read through more than one PPM, private placement memorandum, the fee structures mirror that of hedge funds, and the whole point of this was not to have fee structures. Now, this is someone's opinion. It's almost more of a statement than a question. Let me tackle that for a second. Again, you have to understand who you are and what your strengths are. Some of you are developers who had capital gains in other areas that you can now repurpose into a deferred strategy, qualified opportunities on investment that plays to your strengths. God bless you. Do it. An SPE, a direct investment, might be right for you. I still, and again, I'm biased. I'm part of a fund that's national, right? That has several funds in queue and already has one with several $100 million under management. So I'm going to tell you right out of the gate, I'm biased against everyone should at least have some exposure through a solid qualified opportunity zone fund, because I just believe in the diversification of it. And I believe in the fact that premium deals are going to be found by those who have the best ability to look at them across the board and have the infrastructure in place to analyze them appropriately with fund managers that have decades or more of experience getting double-digit returns. That's my bias. You need to understand that. It doesn't mean you should do anything I say. It just means I'm disclosing my bias to you. However, let's talk about apples to apples, because when someone says, well, direct investments have no fees, that's not really true. They don't have management fees the way a fund structure does, but they still have costs. So for someone who already has infrastructure, and I'm going to just do this as I speak, I'm going to write you an example. Someone who already has infrastructure and has maybe a full-time project manager on staff, let's say they're paying them $45,000 a year. Maybe they have someone who evaluates and works on getting entitlements through the city or the state or local governments. And so maybe they pay that person $60,000 a year. And these are people that are already on staff. And so when they're looking at qualified opportunity zones in their market, this is already a sunk cost, meaning they incur that 45 and that 60K and any other support staff there that they have, they incur that with or without an investment in qualified opportunity zone funds. So if now they separately have a capital gain on their own side of $200,000, $300,000, $1 million from a stock sale or some other asset purchase, well, maybe it does make sense for them to just take that already existing overhead and leverage it, meaning they don't want to pay more fees on top of that, and they feel confident. Got it? That I understand. But to say that there's no fees is a misnomer. Apples to apples, there is cost in all scenarios that we just laid out. Let's say you're someone who has several $100,000, several $1 million worth of capital gains from an investment class that was not heavy on real estate development or technology development. Because again, 90% of all capital that goes into qualified opportunity zone markets has to be into something that is inside of that. It either needs to be a business, which we're waiting on further guidance from what the rules and road of that will be, and incentives will be on treatment standpoint from the IRS. We should get that in June. But we know that 90% of that investment capital under management has to go into a qualified opportunity zone track. That means it could be real estate development heavy and or a business that's operating in that qualified opportunity zone, but we don't know all the treatment yet. So again, partially blind decision. So most people will right now default to the real estate development side because there's more clarity to how that will be treated. Okay. But 10% can go into anything, meaning 10% can go into non-opportunity zone investments that are either contiguous or near it. But 90%, so call it most of your capital, has to go into a business or a development project that is inside of a qualified opportunity zone. Since that's the case, the ability to analyze the caliber, quality of that market, that geographic economic ecosystem, the businesses that are potentially going to be in that, the developments and the costs and the related upside over a 10-year horizon of that market or the risk associated with, that requires professional experience. And if you made your money selling stock or doing something that had nothing to do with this, you may not have that team in place, in which case I'm going to argue that a fee structure, which will look something like this. Market right now is Some funds I've seen out there are slightly below 1%, but when you factor in their accounting management fee, it gets to like 1.25. So let's just say between 1 to 3% management fee. I'll explain what that is for those who don't know. And then carried interest, which is the incentive compensation of 15 to 30%. This is pretty standard. You're going to see most things within this range, 1 to 2 and 15 to 30. What you'll hear a lot in the layman's or in the industry speak jargon is 2 and 20, 3 and 30, 1 and 15. What that means is 1% management fee annually plus 15% of the carried interest profits. So 1 and 15, 2 and 20, it's all that. So let's use an example of 2 and 20. This is common in VC, it's common in hedge fund, it's common in qualified opportunity zone funds. I know this is a little hard to read, but since the question came in and it's been in multiple times, I just wanted to do this in real time. So let's just take an example of someone who has $250,000 in capital gains, meaning you made that money, you can't 1031 exchange it, you're interested in how you can defer it through an opportunity zone investment. $250,000 at a liquidation preference, which we'll explain what that is in a second. But essentially, let's say the liquidation preference, which market for this seems to be on these kind of funds coming in between 1 and 1.07. So 1x to 1.07x. I'll explain what that is in a second. But essentially, if you're paying, let's go right in the middle here, 2% a year in management fee, the typical fund life, again, because you have to hold these for 10 years, is a 2% a year. That's the middle of 1 and 3. So 2% a year on 250 is $5,000 a year. And you say, oh my gosh, that means that $50,000 of my 250 isn't going into an investment. It's going into paying my fund managers to invest for me. This is the knock that people that are anti-fee will tell you. The incomplete part of that is most PPMs and most of these management agreements will have what's called a liquidation preference in there too. And again, I can't tell you what everyone does, but a liquidation preference might look something like 1x to 1.07. What that means is that when you take your money out, the liquidation preference to the limited partners means 1x, in this example, just use 1x. 1x, your invested capital comes back to you first before any carried interest profits are distributed. Now, on a 2 and 20 model, that means that 20% of the profit will go to the fund managers. 80% will go to the limited partners. Well, if you do the math, starting in year 1, $250,000 put into a fund that has a 2 and 20 model means that for the next 10 years, $5,000 a year will be drawn down out of your 250 principal to cover diligence, overhead, management, all the work that that fund does to manage your money and find the deals and manage the portfolio and create returns. So on the course of a 10-year period, 5 times 10 is $50,000. However, when you have a 1x liquidation preference, what that means is 1x, before anybody gets any profit share, you're getting your principal back. So 250 times 1 is 250. So you recapture at exit the $50,000 in fees. So you're not really spending that money, if you think about it that way. That money's being used to allow the fund manager to get you the best deals possible and the highest returns possible for the period of the next 10 years. And at the liquidation point, you will get that money back. So that's one way to think about it. The other way to think about it is 20% on the profit. So let's say that you average 7% ROI. And again, we're not going to factor in the fact that 5%, because this is a tax-free gain, is actually the same as a 7% roughly non-tax-free gain. But let's just say you take 7% ROI over the next 10 years as that's what you get. On a 1x liquidation preference, what that means is that you'd have $250,000 worth of profit. The incentive compensation, the carried interest, if you had a 20% carried interest split with your fund manager, 20% of that 250 gain will be $50K that they earn, and you will net $200,000 tax-free. So on your $250,000 investment, you now have $450,000 after fees, tax-free. Again, caveat being in year 7, of course, we talked about this last webinar, just the caveat. In year 7, you are going to pay the reduced tax. So the step up in basis at year 7 would be 15%. So on $250,000, you're going to basically save 15% of the capital gains tax that would otherwise be due this year. So call it roughly, you're going to pay 20% instead of 23.8. And you're not going to have to pay that till year 7. So if you back out that just call it 20%, that $50,000 in tax that you're deferring that you will have paid there, you're going to be up net of fees and net of the deferred tax, $150,000 on that $250,000.